All right, good morning, everybody. It's August 9th. It's the weekly review where we take a look at what happened last week. We look at the major events, try to use that to tell us, what's coming in the next week and weeks. As far as last week, we had a sell-off, and the Russell took the brunt of it. That brings the Russell almost back to even on the year. You're pretty much even everywhere except for the Nasdaq. That's where the strength still resides, even though there's some weakness starting to creep into that. So negative week, Dow down on the year, 2.5% at this point. So you can see, that the good times, maybe they don't just keep rolling. Technically and fundamentally, what do we got here? Out of the 7,000 stocks that I track at TA today, 2,700 are lower than the lows from last October at this point. That's roughly 38% of all the stocks are trading at lower prices than they were back in October last year when we took that big dip. The buyers, on the other hand, they continue to buy the lows, sell the highs. That hasn't changed. That's why we have the range. That's true here. That's true abroad. If we look at the earnings are basically over. They really didn't do much for the market. They came out gangbusters on those big stocks, right? Big cap stocks at the beginning. But since then, they haven't done anything. We had some stronger PMI numbers last week, and the employment numbers were really pretty strong as well. Not a surprise, but they were strong. And so at this point, it looks pretty much like a lock. The Fed is probably going to move in September, and that means to me this market's going to have to price that in, and I think that's part of what we saw happening back here last week. Europe, it's no longer facing the huge uncertainties. That's a positive. With the Greek situation pretty much resolved, the bailout talks going on, and it looks like that's going to happen. Although Asia now is still facing some pretty good uncertainties with respect to China. I do think we're going to see a range. It's just a question of, will the range be at these lows that we've seen already, or will they be lower? So I want to spend a little time this morning, which is a little bit different than what I've done in the past. But I want to spend a little bit of time and I want to talk about those stocks making new lows versus October last year. One of the things I try to do is look through all the earnings each quarter when they come out to give me a good feel of what's going on. So that means I flip through a lot of stocks. And so that was kind of what drove this little investigation I did this weekend, which was to try to look back and say, okay, I see so many stocks breaking down. And I'm looking at roughly like this week I would think I looked at 1,500 charts this week, and I saw lots and lots of breakdowns, a lot of weak charts. And so then I asked myself, I said, okay, well, if that's the case, then do we see any kind of useful information in the details, right? Devil's already always in the details, and so do we see any kind of information in the details that tell us anything? And so I was interested in that, something I've talked about many times, and that is that we see these indexes 3% off their highs, yet I see so many breakdowns in all these various stocks that I look at. And why is that? Is it because of the weighting structure, in that the large cap stocks are holding this thing up? Is it something else? What is it? And my suspicion is that's why. And so I started looking at it. So anyway, to make a long story short, I just grouped them by the stock sectors. I sorted on the market cap in this case. And I said, okay, of those out there, right, which ones have the most breakdowns, in terms of new lows compared to October last year. And if you go down to the bottom of this list, you can see it. Energy, the OIH, the metals, basic materials, all of those fairly heavily, new lows compared to last year. Big cap energy is 100%, the OIH 95%. So you can see the kind of damage, but it's all in these areas, right? From here down, basic materials down, is where the most damage is done. Now you're starting to see it in technology, and in here, you know, 29%, or what is it, 29% of it in technology, also showing the same sort of breakdown taking place. But then from there up, right, you're talking about a third, a little less than a third. But when you get up here to the top, healthcare, biotech, semiconductors, which is interesting, on market cap, semiconductors haven't broke down, but they have in terms of the general numbers, and we'll see that next. Financials, discretionary, durables, so forth, right? Now go to this one. This one is stocks, the same list, right? This time sorted by just the percentage of stocks under the lows. You know, what's the percentage under the October lows? And as you can see here, you know, if you forget about market cap, 25% are under the lows, and as you go down the list, you get the transports. Now here you're going to see, where was the technology? Technology still about the same, hasn't changed much, but then the industrials 44, transports 50, basic materials in this case 71. You can see the damage on the general, just, you know, broad swath. Look at all the stocks. The damage is quite heavy, and it is the weighting structure that is holding this thing up. And if we look at that weighting structure, and here's the S&P 500, you can see how it's weighted, right, in terms of what are the most important sectors. And when you get down here, energy is only 7% of it. Your basic materials are 3%. So basically 10% of where the most damage has been done up here, right? That's only 10% of the whole weighting of the S&P 500. So massive damage in areas where it hasn't mattered in terms of the weighting structure. And so that is the crux of, you know, the argument, right? And that is that, yeah, you've got huge damage, you've got a lot of stocks in trouble, and you're seeing it bleed across other, you know, sectors, but the weighting in those other sectors is holding them up. Healthcare, right? Biotech, the semiconductors themselves, the percentage of stocks with a market cap that's high, where those stocks or those sectors are making new lows is very low, right? I mean, those big cap stocks are holding on, and they're holding this market up, and they're concentrated in the sectors that matter to the S&P 500. So it's why you can have stocks trading at new lows, charts looking like hell, and the index is still holding at the highs. So, you know, my takeaway from this is that anything commodities has been just blown away. The healthcare, biotech, and all that, right, or where the strength is. And if you take those weightings, right, that weighting structure, even though it's a little contrary to what I thought, it's really the general sector strength in the sectors that matter, right, that make up the bulk of the indexes. The weighting inside those is what's holding this thing up, because 54% of the sectors, 54% of it, are the ones that are still doing well, and where the big caps inside of them are also doing well. And so that's really what's driving all of this. And so if we start to see those big caps break down, right, if we see this weighting up here start to change, then we're going to see a change in these indexes. So one of the things I'm going to do is I'm going to actually do this and pull the numbers back a little bit farther. I was using the October lows, but I may go back and find a better price point to compare to as we go forward. But right now, you know, I want to benchmark them now, because October lows pretty soon won't be the benchmark anymore, or potentially it will change. So anyway, I have to give that a little thought, but I want to benchmark this so that I can compare it going forward to see if we're starting to see that deterioration where it matters, in which case we're going to see it in the indexes. If you add technology to that 54%, 74% of the weighting, 3/4 of it, right, is still doing okay, and that's why we see these indexes where they are. So unless we start to see those sectors begin to break down, the big cap stocks inside those sectors break down, we're not going to see a serious sell-off, and that was the takeaway. So what's the positive, right? The long-term bias is still the upside. So let's take a look at some of these charts. You know, even though we're flattening out up here, the long-term bias has to be seen as up still. It hasn't changed, right? Here's those October lows we were just benchmarking against. And so you can see here on the long-term chart, you know, this thing still looks fine. There's really not an issue. Pull it back to the weekly. You've seen how much it's flattened out. This week, once more, it held on this swing point low. It's like the S&P is unwilling to give up this swing point low. And we've got a bunch of them down here, so when they start to break, it's going to be a fast move probably. But right now, still holding them, right? Still the same case that we've seen before. If we look at the commodities, you know, Friday, we had another stock save. Before I go to the negatives, we had another stock save, and that's what I was just showing you there, in that if we come back here and look at the S&P on a daily, you did a hammer reversal, got under, back over, had a little less volume, and you saved this break on this daily time frame, which was also a weekly time frame. And so, you know, on the weekly time frame, this thing holds again. It looks like it's probably going to bounce. If you look over at the NASDAQ, that one also did the same thing, a little hammer reversal, less volume. And if you look at the Russell, even though the Russell did break down again, it also held this swing point low on a daily. This break was actually on a break of a swing point low. You can see it back here on the weekly. It broke here. So you got multiple swing point breaks on the Russell, but on the daily it held. So all of that makes me think that we're probably going to see a bounce again to start the week. The negative side, that Russell 2000 I just showed you, it broke on multiple time frames. It joins the Dow having done that now, and so we've got intermediate term transitions to sideways on both of those indexes. Usually when you see 2 or 3 start to change, you typically see most of them start to change. And if I pull up that view, you can see we're starting to have multiple breaks now, or multiple trend transitions across these indexes, and we already have it happening, and already has been happening on the sectors, right? And so we have, you know, 5 of the sectors, although they're not the important ones, you know, they've started to break, and so far it hasn't shown up in the indexes because we have the key ones, right, still holding bullish. That's the difference. That's what's happening. You can see it here. You can see it in those numbers I just showed you. It's the story. It's really the story of this market right now. So coming back here, commodities totally falling out of bed. Oil, gasoline, copper, they're all making new lows. Continuous commodity index itself makes new lows. So new lows across the board on these indexes that are related to commodities, right? Just totally devastation across these. I was going to pull up the GCC here, and you can see it makes new lows. Let me get that one up. So here's the Russell. Let me get the GCC. Here's the daily, but look at it on the weekly. You can see new lows again. So commodities in general just devastated, right? Emerging markets are starting to be hit again. They're trying to make new lows. So if I look at those, and this is all a result of dollar-denominated debt that's driving this, right? As the dollar gets stronger, it puts more pressure on anybody that has debt that's priced in dollars, and that's what we're seeing here. If we look at the fundamentals, what was positive this week? Well, the PMI numbers in the U.S. were definitely positive this week, and the employment numbers as well. It's a good thing and a bad thing in that more than likely we're going to have to price in a Fed hike, and I don't know if that's priced in. I suspect it isn't. We also had earnings quote-unquote beat again, although they were down on the quarter. So analysts got them down, you know, I think it was 3.5% negative was the number, and they come in less than 1% negative. So, you know, if you want to call that a beat, that was a beat. And then we've got the fundamental negatives on the flip side. The European growth downside, you know, soft numbers this week. I think that's to be expected. We saw the exact same thing happen with the QE in Japan, in that everybody gets enthusiastic, everybody starts thinking things are going to get much better, but then again they hit this kind of trough after the initial enthusiasm, and then eventually that QE comes back and kicks in, and I suspect we're going to see the same thing happen there. But near term, that's a negative. And the fundamentals on China remain weak. What do I expect? What do I want to watch for? It's the ranges. It's all about the ranges. And as long as those ranges hold, then this market's going to hold. We did see another stretch of those ranges to the downside. I expect some sort of a bounce this week to start. But if they flip around, I expect that bounce. But if they flip around and we start doing these retest regens and they start to regenerate lower, then we're going to have to think this market's going to sell off. Economic highlights, really, I don't think this week's a big week in terms of this. You've got some industrial production numbers, some GDP numbers out of Europe, but outside of that, not a lot going on. What's my bottom line here? I think the risk remains the same that we've seen, and that is if those multiple swing point lows start to break, right, we're going to have a real issue. And so if I pop up the S&P 500 again, just to remind you, and I'm sure you're tired of looking at this just as I am, but if those swing point lows start to break on this time frame, we've got one here, this one, and the real ones are here on the weeklies. You got this one, that one, and then these down here. I think a break of these are going to lead to a fast move down to test those. And I think what's really important to realize here now, I'm going to bring this back up and put it on the daily. What's important to realize now is you actually have nested potential ABCD structures that are about to try and form. And what I mean by that is if this push up this week that I'm expecting fails quickly, you're going to have some nested ABCD structures to come down here and actually get an undercut of these swing point lows. Now, whether it will hold them or actually bounce back again is a different question. But if they do get down here and they get this low, more than likely that swing point low on the weekly time frame, this one over here, is finally going to break, which again is going to cause another transition on another major index on the weekly time frame. So I think that's the thing to be watching. Until we get those breakdowns, though, it's just more range trading. Remember questions. There was a question about doing an Apple-like video of Disney after earnings, and I thought this was probably not a bad one to pick up next. And the reason for it is that it's a different type of trade. This is a bounce trade, and it's going to be a bounce trade based on the daily and the weekly time frames. And so if I look at it on the daily, right, they reported earnings, they just get shellacked, right, huge volume. But if you pull it back on the weekly, right, it's a little different story here in that you've had a very strong stock. If you look at it there and look at it on monthly, and so usually a strong stock is going to give you a bounce. And so I think this might be a good candidate for a bounce trade type video, doing the same sort of idea that we did with Apple. Rather than looking at a a retrace longer term, intermediate term, here we're going to look at a short term, just a bounce trade. And so I'll pull that up maybe and try to do that video here a little bit later today if I can. The other question was why the biotechs broke down, and there was a member sent in a link that I took a look at. And so if I tighten this up a little bit so you can see it, it was China gets tougher for the Western drug makers, and it goes over kind of the reasoning here from a fundamental perspective as why that happened. One of the things I try not to do is to look too much at the fundamentals. I think the fundamentals on the macro economics always make sense to be abreast of. But in terms of all the individual sectors and stuff, that's a lot more difficult for me, at least, and I think for most people, to use fundamentals to drive why this or that is happening. Independent of what drove it, the setup was there on a technical basis, right? On a neoclassical read, you had the test failure at the breakdown bar, and I talked about this as it happened, right? I did it in the nightly show, and I talked about this test failure on Wednesday probably was going to set up a pullback. Now, I didn't know it would be this deep of a pullback, but if you look at this index, right, you'd already had volume coming off on a break here, right? And when you get that kind of volume, you come up and you test it on nothing, right? And if the whole, market also is kind of set up to pull back, which it was, you can get one of these big, fast, heavily invested hot sectors. They're not going to pull back slightly. When people dump, they're going to dump, and they're going to dump fast. They're not going to wait for intermediate term trade signals. They're going to dump on dailies, and that's exactly what they did. So now if you look at it, right, this thing has come back at this point into these large volume spikes, which were downside. They're all support in this area. It comes into it. It doesn't have quite the volume. My guess is this thing will bounce as well. But the setup there on that was really a technical setup. I don't know that this is going to push this all the way down again. When I look at the kinds of volumes that we've had, you can certainly get a push back to test these lows because they're high volume lows. But at this point, I don't want to get too involved in the fundamental aspects and ask myself, okay, are these breaking down for good? I think it's way too early to know that. I'd much rather trade these off the technicals if I'm trading them based off the fundamentals. The portfolio, I don't have a lot to go over here. We did an RWM trade that worked out pretty good. We got stopped out of Apple and Lilly last week. I don't want to make any trades anymore. I'm just not interested. The only trade I want to make, if I'm making a trade, is I want to make a trade on the indexes with a short. Elsewhere, I want to try to just look at fundamentally strong, technically strong stocks that we think that we can trade on the intermediate term basis. So we have to have very wide stops with the intention of trading them that way so we don't get stopped out. Otherwise, we're just going to continue to get thrashed out in this market as we have the last time we traded and 2-3 months ago when we tried it also. And so right now the ideal is stay away from those and focus on just fundamentally long-term type trades where the technicals look strong as well. Buy those dips, have long, big stops, right? And evaluate them as they come back. As long as the general market looks fine, then you can buy more of them. If it doesn't, then you don't, right? And you wait. And you keep your risk down on that first entry, then add in more where it makes sense, if it makes sense. Strong sectors and stuff are down here as well. So, when I look at this week as a whole, negative week, but we're still in the range, folks. I do think there's a good potential here that we get a weak bounce and we actually get an undercut and a break. That may finally set up a better buying opportunity than we've had in I don't know how long. So we'll have to see if it plays out that way. For now, I think that's what we have to keep looking at. A lot of weakness across a lot of stocks, but the strength still remains in those sectors that matter, and that's why this market continues to hold up. Thanks for listening to me and joining me. If there's anything I do to help you, if you got questions, send them in and I'll review them here, as well as, of course, respond back to you individually, typically, as I usually do. Thanks, take care, and I'll talk to you soon.